Welcome everybody. In this video I'm going to explain as simple as possible what stocks are and why they exist. For this purpose, let's say we start our own company, the AV Ltd. Our company, the AV, sells products. In this example, we produce and sell shoes. In order to start our own company, we have to invest money. We have to make an investment. First, we have to pay the foundation costs. And before we can think of producing shoes, we have to buy the appropriate machines, equipment, hire employees and so on. We have to pay for these things before we have earned even 1 cent. Here arises the question, who pays for all of this? Well, there are different ways to find the necessary investments to start and advance our business. Firstly, it can be our own capital, which means we pay for it out of our own pocket. Or we can get a loan from a bank, friends or family. Thirdly, we turn to investors. These are usually wealthy individuals who provide financial means in exchange of shares of a company. Often, those individuals are called business angels. Lastly, there exist professional companies who do nothing else but investing in other businesses, hoping that these businesses will grow and the purchased share will increase in value. These professionals are called venture capitalists, or in short, VCs. We, as AV, borrow money from the bank and start with the production of our shoes. After several successful years, we have grown very fast and now employ over 100 people. We then decide to sell our shoes in other countries as well. We rapidly expand, and after many more very successful years, AV has become a worldwide brand, employing thousands of people. But now we want to expand our product portfolio, and not only produce and sell shoes, but also sportswear. Of course, this requires an unbelievable large financial investment. We have to build new competences, new production lines, thousands of new employees must be hired in a few years. We have to push worldwide marketing and much more. According to our first calculations and analysis, it will take at least 500 million. Well, now we ask ourselves the same question once again. Where can we get so much money? We do not want to take such a large loan from a bank. Therefore, we decide to go public and become a publicly traded company. This means we sell a part of our company to the public. And the public, meaning every citizen, every institution, every company that is allowed and capable of buying shares, can acquire a part of our company. This allows us to free up an extremely large amount of financial resources to finance our portfolio expansion, of course, in exchange for a big portion of our company. Finally, we decide to sell 50% of our company to the public. This process of going public for the first time, also known as IPO, initial public offer, is very long and quite complex. And perhaps we will explain this in more detail in another video. It is calculated that 50% of our company is worth 2 billion, and we decide to offer this 50% in 50 million small parts to the public. That is, 50 million shares. So, if we make the simple calculation, 50% of our company is worth 2 billion divided by 50 million shares equals a price of $40 per share. Everything is done, and the big day for us as AV has come. The day of the IPO. The first day our shares are offered to the public. Through a different process, a certain percentage of the shares were already sold to investment banks before the IPO, but more about that maybe in another video. Now, the bell of the Wall Street rings in the morning, which means that the stock market is open, and our shares can be bought and sold starting at the price of $40. We are lucky, and the shareholders rush in to buy our shares. This means that the public, or often simply called the stock market, believes that our company will continue to grow in value and our shares will be worth more in the future than they are today. This is basically the reason why the investors invest in our company and buy our shares. The buyers hope that at some point in time, the shares which they bought for $40 will be worth more. If our shares grow in value up to, let's say, $80 per share, then the shareholders would have doubled their investment or increased by 100%. The more buyers want to buy our shares, the more expensive they become. The more investors want to sell, the lower the price. Back to our first day. Since so many buyers want our shares, the price will naturally go up. There are more buyers than there are shares. So the buyers steadily have to offer a little bit more to have our shares. As a result, the price of our shares increased in the first day from $40 to $50, a 25% increase, which is awesome. For us as AV, this means in return that we have raised enough money to expand our product portfolio. A win-win for us and the investors. And this is basically the reason why stocks exist. However, what happens if we need more capital? Do we have to sell shares again? What if nobody wants to buy our shares anymore? Is there an upper limit? How do I buy shares myself? And much more in the next video.